Have you ever taken out a loan on a car in the UK? Well, there's a chance you could be set for a big payout. UK banks and other lenders are bracing for heavy compensation costs tied to their use of now banned practices for motor finance. Customers could be due billions of pounds in compensation if Britain's financial regulator chooses to implement a redress scheme following its review into the so-called discretionary commission arrangements. These arrangements allowed brokers to adjust interest rates on car finance without the knowledge of the borrower. The Financial Conduct Authority announced in January that it would review whether customers were unfairly charged between 2007 and 2021 when the practice was banned. But analysts have since raised their estimates of banks' exposure to the probe after a test case in the courts ruled in favour of borrowers and has made it more likely that the FCA will launch a compensation scheme. The Court of Appeal said a broker could not lawfully receive a commission from the lender without obtaining the customer's fully informed consent to the payment. The news has hammered shares in Close Brothers, which is considered the most exposed bank in relative terms. It has also weighed on Lloyds banking group, which owns the UK's biggest auto lender, Black Horse. According to worst-case estimates by RBC Capital Markets, Lloyds could take a £3.9 billion hit to its profits, followed by Santander UK at £1.9 billion, Barclays at £440 million, and Close Brothers at £387 million. These estimates include compensation, interest, and administration costs. Forecasts for the overall cost of British banks have topped out at around £16 billion so far. This level would make a redress scheme the UK banking sector's biggest since the infamous PPI scandal, which saw banks hand back more than £38 billion between 2011 and 2019 over missold payment protection insurance. The FCA is due to set out its next steps on the motor finance review in May. For the latest updates on the story, visit cityam.com and follow us on socials.